Hello guys, welcome back to my YouTube channel. In today's video, I want to teach you how to record payroll in QuickBooks. But before we do that, I want to also show you something. I want to show you some basic laydown rules of accounting so that you'll be able to understand how these transactions are processed in QuickBooks, and it will also help you identify anywhere you are making an error entry so that you can correct it immediately. So here are the corrections I want you to make. Here are the things I want you to take note of. Now, the first thing I'll start with is the basic accounting principle, which is the principle of double entry system. The principle of double entry system states that wherever there is a debit transaction or there is a debit entry, there must be a corresponding credit entry, and this is denoted by DR as a debit transaction, then CR as a credit transaction. So if you understand the way these things work, it will be easy for you to record transaction in QuickBooks, especially when you are dealing with the journal, because the journal is what we are going to be using to record our payroll transaction in QuickBooks. So you have to understand the basic principle. This basic principle of double entering before you can be able to make transaction, record any form of transaction at all in QuickBooks using the journal, because the journal is the only place you apply the double entering principle on your own. QuickBooks is not going to do it for you. The only thing QuickBooks will ask you to do there is QuickBooks will ask you to identify the account that is receiving and the account that is and the account that is giving. So if you are able to identify the account that is giving and the account that is receiving, then it is easy for you to post those transactions in QuickBooks. So the double entering principle also states that it may declare that you debit whoever or whichever account that is receiving and credit whichever account that is giving. So as money is coming into your account, you debit it. As it's going out, you credit it. That is what it means. Now, also look at this place. We have the accounting equation. We have the accounting equation. If you look at it, you see that here the accounting equation states that asset is equal to capital plus liability. Capital is the same thing as equity. Asset is equals to capital. Asset is equals to capital plus liabilities. Then liability in capital is equals to assets minus liability, and the liability is equals to asset minus capital. So these are the accounting equations that guide the operation of any transaction you're doing, you're recording using accounting principles. And also look at this place, we have the four poles of accounting. Now remember the principle of double entry, which says that wherever there is a debit entry, there must be a corresponding credit entry. So now these poles of accounting are the accounts that help us record the corresponding entries of any transaction that passes through this basic accounting principle. Because remember that whatever that is coming here is one step, is one transaction. That's one step towards completing the process of accounting. So in order to complete the process, in order to complete that process, any transaction you posted and it was debited, then it's either is an income or assets. It's either is an income or asset. That is why the four poles of accounting states that we have four poles of accounting. We have the assets, we have the liabilities, we have the expenses, we have the income or revenue. These are the four poles of accounting. So any transaction you are making, you are recording in your business. Any transaction that comes you're making in your business is either going to be an income to your business, or it's going to be an expense to your business, or it's going to be a liability to your business, or an asset to your business. So either way, you must know how to record these transactions in QuickBooks. Like I said, the accounting equations that guide us to know which one is an asset and which one is a liability, which one is a capital, is these formulas. So this formula you're seeing here will guide you in the process of calculating your asset, liability, and capital. So now in recording these transactions, what we are going to do is all the assets in your business are debited. And that is why you have it here like this. All assets in any business are debited and liabilities in any business are credited. Why are they credited? They are credited because it's something you are giving out. So whenever you want to complete the double entry of that, or whenever you make payments or you reduce the amount of liabilities your business is owing, you will now debit the liability account because the liability account is now receiving to reduce the credit amount in it. Now, the asset and the liabilities are financial statement of financial position item, that is balance sheet. What we used to know as balance sheet is no more balance sheet, is statement of financial position, SFP. They are SFP item. And also what we used to know as profit and loss is no more profit and loss, is POL or statement of changes. Sorry, is POL, use the abbreviation, or profit or loss statement, because you cannot have a profit and at the same time have a loss. That is why it's either profit or loss statement. Now, in it, this is where you're going to find your expenses and you're going to find your income. So, like I said initially, I said every transaction must have a corresponding double entry system. Now, this transaction that has been recorded here as a debit transaction, if we are using the cash book journal, which is, let's say this is sales you made, and we are using the cash journal to record this thing, and we are using the cash journal, so this is sales, and we are using a cash journal to record it. What it means is that this now becomes, this amount is a debit transaction. So if this amount is going to be recorded in the income account, it is going to the credit side because it has already formed one side of the entry, which is debit. So it's going back to complete the other side of account, which is going to be now credit in the income statement. Remember that this is cash book. Cash book is not specific to any account. Cash book is a self-balancing journal. Any transaction that has to do with cash is going into that cash book. Any transaction, either income or expenses, is going there. So now when you want to separate it, all these transactions that are debit in the cash book are automatically known as income. So when you are going to take them to the income account, which is the general journal account, it's now going to be you will now record it in the credit side of the revenue or income account. That is it. Now, if this is an expense, let's say this is transport fare. Transport fare is an expense already. So let's say the expense is 4,000. So if you're recording this expense now, which is a transport fare, it's already a credit transaction in the cash book journal. So when it comes to the expense account, which is expense is a general journal account. So expense account, what you're going to do now, you're going to debit the expense account. You are debiting the expense account because the expense account is the one that received the money for the transport. Are you getting me? So that is what I want you to know in this account before you even go in details on how to record payroll transactions. I want you to understand that every transaction in accounting follows a double entry principle, and even the one we are going to do in QuickBooks here now is going to follow a double entry principle because it's very tricky. That is why I made out this time to make sure that I teach you this basic principle so that you understand how it's going to work, how it works, and if you make any mistake, you can easily trace your steps back and correct your mistakes immediately. So, having said that, Now, this is how to record employees' payroll in QuickBooks. We are using QuickBooks Desktop. Remember that payroll is another aspect of accounting that you can specialize on. We have payroll accountants. Yes, you can specialize as an accountant, you can specialize on payroll only. And that is why QuickBooks offers it as a service separately on its own. QuickBooks offers that payroll management as a service separately on its own because there are a lot of deductions, there are a lot of tax laws, yes, that are applied to pay employees. And as a payroll accountant, you must understand these tax laws and how they apply and how you can make the calculation. Anyway, but in this video, I will not be making those deductions. I'll just record the payroll transactions without any deductions. Then in the later video, then I'll teach you how to make that one, how to record a payroll transactions with other statutory deductions and contribution or benefits accruing to employees in an organization. So that's what we're going to do here. So the affected accounts in this what we are going to do today is we have the payroll expense account is going to be affected. We have the payroll liability account is going to be affected. We have the cash or bank account, which is also going to be affected. So these three accounts are what we are going to use in recording in recording our transactions in QuickBooks today. All right. Then after we have done that, we now establish how much are we going to pay our employee at the end of the month. Believe me, not all organization pays their employee at the end of every month. No, some organization don't pay employees at the end of every month. Yeah, reason is that some employee came in the middle of the month, some came in the beginning of the month, some came in towards the end of the month. So it is not possible to pay them at once. But what organizations do, they will capture all their payments to know how much exactly they are paying their employees. So if they know how much they are paying their employees, then they can now make the payment to those who are eligible for payment at that particular period of time. So what we are going to do now, we are going to establish how much is payable before we can now make the payment. So when we establish how much is payable, how do we do that? When we establish how much is payable, how we do that is we record it, we debit the payroll expense account, and we credit the payroll liabilities account. Now, when we are now ready to make the payment, what we are going to do next is to debit the payroll liability account because we have already established how much we are going to pay our employees, and it's a credit transaction, which is a liability. Like I say, remember, it's a liability, which is a credit transaction here. So because it's a liability, we want to now make payment, we want to reduce the payment. We'll now debit it with the amount we are paying. And when we have done that, we now say, okay, this amount we are paying now, which account is it coming out from? Is it coming out from our bank account, our check account, or our cash account? Any account we are making the payment from, then we now select it and credit that account that is given. Remember the principle of double entry. They say credit the giver and debit the receiver. So the giver now is the giver becomes our bank and cash, our bank or cash account is now our giver. So we credit it, and our liability payroll liability account becomes the receiver. We debit it. So I believe you have understood what I just said. If you have not, you can use the comment section and drop me a comment and ask me any question. I will be glad to assist you or to put more clarifications based on that. But these are basically what you should understand before you start making any transaction, before you start recording any transaction in accounting as a whole. So you have to understand these basic principles, the force of accounting, the accounting equations before you start anything in accounting as a whole. All right, having done that, let's go right into the video as we start recording as we start our postings in QuickBooks.